What if I told you there are simple chart patterns that anyone can easily learn, which will help you know when to buy or sell? And to prove it to you, let me share a few of my recent trades. I used the descending triangle pattern and a double bottom pattern to spot a trend reversal in S&P 500 ETF SPY. I took an options trade and managed to make over 60% in profits in under 20 minutes. I also used a wedge pattern on Baba and Baidu stocks, which resulted in over 250% in profits. These patterns really do work. They help me find the right entry and exit points. And with a little practice, they can do the same for you. In this video, I'll walk you through the key chart patterns that every trader should know to make more profitable trades. By the end of the video, you'll know how to read these patterns and spot the best entry, exit, and stop loss points. Plus, I've got a free cheat sheet with all the patterns we'll cover in this video, and you can download it to start practicing right away. Let's start with the basics. What exactly are chart patterns? Chart patterns are shapes and formations that show up on stocks' price chart, showing the battle between buyers and sellers. By learning these patterns, you'll be able to follow market movements more easily and get a sense of what might happen next. Instead of guessing when to buy or sell, these patterns give you a clear signal to help you make smarter trading decisions. You can think of them as a compass, helping you find direction in the market's movements and guiding your trading decisions. Before we dive into the chart patterns, it's important to mention that understanding uptrends, downtrends, and support and resistance levels is essential for following what we'll cover in this video. These concepts are the foundation for recognizing and using the chart patterns effectively. If you're not familiar with them or need a quick refresher, be sure to check out my previous videos where I explain them in detail. You'll find the links in the description below. First set of patterns we will discuss are categorized as reversal patterns. A reversal pattern signals that the current trend, whether uptrend or downtrend, is about to change and reverse directions. Reversal patterns help traders spot the turning point and time their entries or exits accordingly. Let's break down the key reversal patterns and show you how they work. The first pattern we'll cover in this video is the double top. This is a bearish reversal pattern signaling a shift from an uptrend to a downtrend. It forms when the price reaches the same high level twice, but fails to break through and retraces back down. In other words, buyers try to push the price higher, but they can't get past the resistance level, and the price starts to fall. The key thing to watch for this pattern is the break of the support line, also known as the neckline, which forms at the low point between the two peaks. When the price breaks through a support, resistance, or a trend line, this is what we call a breakout. However, not every breakout will result in a profitable trade. Sometimes a breakout occurs, but if there is not enough momentum behind it, the price can quickly reverse. This is known as a false breakout. To avoid getting caught in one, it's smarter to wait for a confirmation, such as increased volume or clear candlestick signals. Another thing to keep in mind is that after a breakout, the price often comes back to test the level it just broke. This is known as a retest. While a retest can provide extra confirmation that the breakout is strong, it's not mandatory. The price could continue moving in a breakout direction without testing that level again. This concept applies to all of the chart patterns we'll be discussing in this video. For the double top pattern, the optimal trade is going short when the price breaks and closes below the neckline. I can't stress this enough. The price must close below that level before considering to take a trade. For the ideal profit-taking target, aim for a price zone that's roughly the same distance from the neckline as the height between the two tops and the neckline as shown by the two orange lines. More conservative traders might aim for earlier profit targets, like key support areas such as moving averages, volume-weighted average price, otherwise known as VWAP, or other support zones. I'll cover these indicators and much more in my future videos. Now let's talk about stop loss level. A stop loss is simply a point where traders cut the trade to minimize their losses if things go against them. I'm a big advocate for always using stop loss, especially as a beginner trader. More experienced traders can make exceptions. For the double top pattern, the stop loss is usually placed just above the second peak to protect against the possibility of the price moving higher again. A more conservative approach would be placing the stop loss just above any other key level before the resistance line, ensuring that the stop loss triggers only if the price breaks back above that zone. Again, key levels can be moving averages, VWAP, and so on. Double bottom is the bullish counterpart to the double top. It's a bullish reversal pattern signaling a shift from a downtrend to an uptrend. The double bottom forms when the price hits the same low level twice, but fails to break lower. Sellers attempt to push the price down, but can't break through the support level and the price starts to rise. This pattern is confirmed when the price breaks and closes above the resistance line, also known as the neckline, formed by the high point between the two bottoms. The optimal trade for this pattern is going long once the price breaks and closes above the neckline. For profit taking, the optimal target is usually a price zone that's about the same distance from the neckline as the height between the two bottoms and the neckline. For more conservative traders, a similar approach to the double top applies here as well, by aiming for earlier profit targets, such as key resistance areas. For managing risk, the optimal stop loss is generally placed just below the second bottom to protect against further downside. A more conservative approach would be placing the stop loss just below the earlier key level to ensure that the stop loss only triggers if the price breaks below that zone. Triple top is a bearish reversal pattern similar to the double top but with an extra peak. It forms when the price tests the same resistance level 3 times but fails to break through, indicating that buyers are losing strength. The pattern is confirmed when the price breaks below the neckline, which is formed by the lows between the 3 peaks. The optimal trade for this pattern is going short when the price breaks and closes below the neckline. The profit target is usually set at a distance equal to the height between the 3 peaks and the neckline. A more conservative approach will be targeting earlier support levels. The stop loss is typically placed just above the 3rd peak to limit risk if the price pushes higher. A tighter stop loss can be used for this pattern as well. The triple bottom is the bullish counterpart to the triple top and is a bullish reversal pattern that signals the end of a downtrend. The pattern forms when the price tests the same support level 3 times but fails to break lower, showing that sellers are losing control. The pattern becomes valid when the price breaks and closes above the neckline, which is the resistance line formed by the highs between the 3 bottoms. The optimal trade for the triple bottom is going long when the price breaks and closes above the neckline. For profit taking, the target is often set at a price zone equal to the height between the 3 bottoms and the neckline. A conservative approach might target earlier resistance levels. The stop loss is typically placed just below the 3rd bottom or below earlier support zones. The head and shoulders pattern is a bearish reversal pattern that forms after an uptrend. It consists of 3 peaks. The middle peak, known as the head, is the highest, and the 2 smaller peaks known as shoulders on each side. This pattern signals that the uptrend is weakening, and sellers are starting to gain control. The neckline, which connects the lows of the 2 shoulders, is the key level to watch. The optimal trade here is going short when the price breaks and closes below the neckline. The profit target is typically set at a price zone below the neckline, equal to the same distance between the head and the neckline. For managing the risk, the optimal stop loss is usually placed just above the right shoulder to protect against further upside movement. The inverse head and shoulders is the bullish counterpart to the head and shoulders pattern. It's a bullish reversal pattern that signals the end of a downtrend. It has the same 3 parts, the head, which is the lowest point, and the 2 shoulders on each side, which are the higher lows. The pattern is confirmed when the price breaks and closes above the neckline, which connects the highs between the shoulders. The optimal trade for this pattern is going long when the price breaks and closes above the neckline. Profit taking is generally targeted at a price zone equal to the distance between the neckline and the head. For managing risk, the optimal stop loss would be placed just below the right shoulder to manage downside risk. Let's move on to the rising wedge, which is a bearish pattern that shows the uptrend is losing strength and the price may break lower. This pattern forms when the price makes higher highs and higher lows, but the range is narrowing, indicating that the buyers are losing control. The pattern is confirmed when the price breaks and closes below the lower trend line of the wedge. The optimal trade is going short when the price breaks and closes below the lower trend line. The profit target is usually set at a distance equal to the highest high and lowest low price points of the wedge. For managing risk, the optimal stop loss would be placed just above the upper trend line in the wedge. The falling wedge is a bullish counterpart to the rising wedge. It's a bullish pattern that forms when the price is making lower highs and lower lows, but the range narrows, signaling that sellers are losing control. This pattern is confirmed when the price breaks above the upper trend line of the wedge. The optimal trade for the falling wedge is going long when the price breaks and closes above the upper trend line. The profit target is generally set at a distance equal to the highest high and lowest low points of the wedge, as shown by the orange arrows. For managing risk, the optimal stop loss would be placed just below the lower trend line of the wedge. The rounding bottom, also known as the saucer bottom, is a bullish reversal pattern that signals the end of a downtrend. The price gradually curves downward, flattens, and then starts to rise again. The pattern is confirmed when the price breaks above the resistance line at the top of the curve, also known as the neckline. The optimal trade is going long when the price breaks and closes above the resistance line. Profit taking is generally set at a distance equal to the depth of the rounding bottom. For managing risk, the optimal stop loss would be placed just below the lowest point of the rounding bottom. A more conservative stop loss can be placed below the recent low or if the price breaks below the curving trend line. The rounding top or inverse saucer is the bearish counterpart to the saucer bottom. It's a bearish reversal pattern that forms when the price curves upward, flattens out, and then starts to decline. This gradual curve indicates that buyers are losing momentum and the price is likely to reverse. The pattern is confirmed when the price breaks below the support line at the base of the curve. The optimal trade for this pattern is going short when the price breaks and closes below the support line. Profit taking is typically targeted at a distance equal to the height of the rounding top. For managing risk, the optimal stop loss would be placed just above the highest point of the rounding top. A more conservative stop loss can be placed above the recent top or if the price breaks above the curving trend line. Now we'll move on to continuation patterns. Unlike reversals, which signal a change in direction, continuation patterns show that the current trend is likely to keep going after a brief consolidation. These patterns reflect a pause where the price moves sideways or slightly against the trend before continuing in the same direction. They help confirm that the momentum remains strong, offering traders a chance to trade with the trend. The first pattern is the bullish flag pattern. The bullish flag is a bullish continuation pattern that forms after a sharp upward movement, also known as the flagpole, and consists of a brief consolidation phase where the price moves slightly lower in a narrow trend channel. The breakout from the flag signals the continuation of the uptrend. The pattern is confirmed when the price breaks and closes above the upper trend line of the flag. The optimal trade is going long when the price breaks and closes above the top trend line. For profit taking, the ideal target is typically the same distance as the height of the flagpole before the consolidation. A more conservative approach would be measuring the same distance from the bottom trend line instead of the breakout point from the upper trend line. For managing risk, the optimal stop loss is placed just below the lower trend line. The bearish flag is the bearish counterpart to the bullish flag. It forms after a sharp downward movement and is formed by a brief consolidation phase where the price moves slightly higher in a narrow trend channel. The breakout signals continuation of the downtrend. The pattern is confirmed when the price breaks and closes below the lower trend line of the channel. The optimal trade is going short when the price breaks and closes below the lower trend line. For profit taking, the ideal target is typically the same distance as the height of the flagpole. Again, a more conservative approach would be measuring the same distance from the top trend line instead of the breakout point from the lower trend line. The optimal stop loss is placed just above the upper trend line of the channel. The bullish pennant, as the name suggests, is a bullish continuation pattern that resembles a smaller, more compact version of bullish flag. It forms after a sharp upward movement and consolidates in a symmetrical triangle or a wedge shape. The breakout signals the continuation of the uptrend. The pattern is confirmed when the price breaks and closes above the upper trend line of the pennant. The optimal trade is going long when the price breaks and closes above the pennant's upper trend line. For profit taking, the ideal target is typically set the same distance as the height of the flagpole. A more conservative approach, similar to the bull flag, would be measuring the same distance from the bottom trend line instead of the breakout point from the upper trend line. The optimal stop loss is placed just below the lower trend line of the pennant. The bearish pennant is the bearish counterpart to the bullish pennant. It forms after a sharp downward movement followed by a consolidation phase within a symmetrical triangle or a wedge shape. The breakout signals the continuation of a downtrend. The pattern is confirmed when the price breaks and closes below the lower trend line. The optimal trade is going short when the price breaks and closes below the lower trend line. For profit taking, the ideal target is typically the same distance from the lower trend line as the height of the flagpole. A more conservative approach, similar to the bear flag, would be measuring the same distance from the top trend line instead of the breakout point from the lower trend line. The optimal stop loss is placed just above the upper trend line. The cup and handle is a bullish continuation pattern. It starts with a rounded bottom, the cup, followed by a smaller consolidation, which is the handle. This pattern signals that the price is likely to continue moving upward, and the pattern is confirmed when the price breaks out of the handle. One important thing to note here is that the handle can be any type of consolidation form. The most common one is the narrow trend channel shown in here, but it can be a wedge, triangle, or just a horizontal consolidation zone stacked between a support and resistance levels. Regardless of the consolidation formation, the pattern works the same way. There are two possible entries with this pattern. The first possible entry trade is going long after the price breaks and closes above the upper trend line or the resistance of the handle. A more conservative entry trade is going long after the price breaks and closes above the resistance or the neckline formed at the top of the cup pattern. Profit taking is usually set at a zone equal to the depth of the cup. For managing risk, the optimal stop loss would be just below the lower trend line of the handle. The inverse cup and handle is the bearish counterpart to the cup and handle. It's a bearish continuation pattern that signals the price is likely to continue moving downward. It forms with the rounded top, followed by a small upward consolidation. The pattern is confirmed when the price breaks below the lower trend line or the support line of the handle. Similar to the cup and handle pattern, there are two potential entry zones for this pattern as well. The first entry trade is going short right after the price breaks and closes below the lower trend line or the support zone of the handle. A more conservative entry trade is going short when the price breaks and closes below the support or the neckline of the cup formation. Profit taking is typically set at a distance equal to the height of the cup. For managing risk, the optimal stop loss would be placed just above the upper trend line or the resistance of the handle. Finally, we have the bilateral chart patterns. These patterns are unique because they can signal a continuation of the existing trend, whether it's bullish or bearish. While these patterns can break in either direction, the key here is that they follow the trend, either continuing an uptrend or downtrend. The first bilateral pattern we will cover is the ascending triangle. This pattern is most often considered a bullish continuation pattern as it typically forms during an uptrend. It consists of a flat resistance line at the top and an ascending trend line at the bottom, indicating that buyers are slowly gaining control. However, in a bearish scenario, it's possible to see this pattern forming during a downtrend. For the trade structure, starting with the bullish scenario, the optimal trade is going long when the price breaks and closes above the resistance line. For profit taking, the ideal target is usually the same distance as the height of the triangle, and then projecting that distance from the breakout point. For managing risk, the optimal stop loss is placed just below the rising trend line. For the bearish scenario, the optimal trade is going short when the price breaks and closes below the rising trend line. For profit taking, similar to the bullish scenario, the target is set by taking the height of the triangle, but this time projecting it downward from the breakout point. For managing risk, the optimal stop loss is placed just above the resistance line. The next bilateral pattern is the descending triangle. This pattern is generally considered a bearish continuation pattern as it typically forms during a downtrend. It consists of a flat support line at the bottom and a descending trend line at the top, showing that sellers are slowly gaining control. However, in a bullish scenario, you may also see this pattern forming during an uptrend. For the trade structure, starting with the bearish scenario, the optimal trade is going short when the price breaks and closes below the support line. For profit taking, the ideal target is usually the same distance as the height of the triangle projected downward from the breakout point. For managing risk, the optimal stop loss is placed just above the descending trend line. In the bullish scenario, the optimal trade is going long when the price breaks and closes above the descending trend line. For profit taking, similar to the bearish scenario, the target is set by taking the height of the triangle and projecting it upward from the breakout point. For managing risk, the optimal stop loss is placed just below the support line. The symmetrical triangle is a neutral bilateral pattern that can break in either direction, meaning it doesn't favor bullish or bearish outcomes until the breakout happens. It forms when an ascending and descending trend line converge to create a symmetrical triangle. This convergence shows that buyers and sellers are in a state of indecision, but eventually the price will break out in one direction. For the trade structure, starting with the bullish scenario, the optimal trade is going long when the price breaks and closes above the upper trend line. For profit taking, the ideal target is the same distance as the height of the triangle, projected upward from the breakout point. For managing risk, the optimal stop loss is placed just below the lower trend line. In the bearish scenario, the optimal trade is going short when the price breaks and closes below the lower trend line. For profit taking, the target is set by taking the height of the triangle and projecting it downward from the breakout point. For managing risk, the optimal stop loss is placed just above the upper trend line. Now let's talk about the common mistakes that traders make. One of the most common mistakes new traders make is relying too much on the chart patterns without waiting for proper confirmation. Just because a pattern forms doesn't mean it will always lead to a successful trade. Rushing into trades too early without confirmation from other indicators can lead to false breakouts and potential losses. Another mistake is failing to manage risk by not setting proper stop loss levels or ignoring key signals like volume, which helps confirm the strength of a breakout. Overtrading based on incomplete or weak signals can also increase the risk of losses. To reduce the chances of making these mistakes, it's important to combine chart patterns with other indicators to confirm the breakout and the direction of the trade. Let's go over a few key indicators that can help you make more informed decisions. First, we have the volume. Look for an increase in volume during the breakout. Higher volume usually confirms that the breakout has real strength behind it. Next, you have candlestick patterns. Use candlestick patterns to confirm your entry and exit points. For example, reversal candlestick patterns can give you an extra signal that the price is about to change direction. You also have moving averages. Moving averages can help confirm the direction of the overall trend. For example, if a breakout happens above a moving average in an uptrend, it's often a stronger signal. The RSI, Relative Strength Index, can tell you if the asset is overbought or oversold. This can give you more confidence in your trade when the chart pattern lines up with the RSI that shows the asset is in a favorable condition. The MACD, Moving Average Convergence Divergence, can help confirm momentum. If the MACD shows strong momentum in the same direction as the breakout, it's another sign that the move could be legitimate. By combining chart patterns with these indicators, you can make smarter and more confident trades and avoid some of the common pitfalls that new traders often face. Check out my previous videos on candlestick patterns and support, resistance, and trend lines for more insights. Make sure to subscribe and stay tuned for upcoming videos where I'll dive deeper into moving averages, VWAP, and other key indicators that can help confirm your trades. And feel free to drop a comment below on what you would like to see next. If you enjoyed this video, click like, comment, and subscribe. It helps the channel a lot. Thank you for watching, and I will see you in my next video.